Welcome to the Protect Your Assets Under Management webinar, hosted by BackNine Insurance. We will be getting started in just a few minutes. Let's give the stragglers a few more minutes to sign on. Thanks. Okay, thank you everyone for joining today's webinar, Protecting Your Assets Under Management Using LTC. My name is Zach Engel, and I'm a brokerage director here at BackNine Insurance and Financial Services. I am here to assist my advisors with advanced case design, as well as product education and unique sales concepts. Just a heads up, everyone will be muted through today's webinar, so sit back, relax, and let's get started. Everyone has a disclaimer. Here's ours. Take a look. As a financial advisor, it is your duty to protect your client's assets. If your client is at risk for major losses in the event of a long-term care claim, you have not lived up to your fiduciary responsibility. This not only satisfies your fiduciary responsibility, but works to protect your assets under management while creating an opportunity for a legacy client. So, what is insurance anyway? It is the leveraging of money to protect larger assets. We have health insurance to protect against large hospital bills. We have car insurance to protect us in the event of a crash. We have homeowners insurance to protect our homes. There is disability insurance to protect us in the event we can no longer work. And of course, there's life insurance to protect our loved ones from a sudden loss. Without the final piece to the puzzle, you as a financial advisor can be leaving your client open to substantial losses from a long-term care event. Let's make sure your client's assets are completely boxed in. Now, let's get back to the topic at hand. Leaving your client exposed to an LTC event can have a serious impact on your AUM. As you can see, there's a far greater chance of an LTC event than a fire or a serious car crash. The cost of care can be expensive. As you can see, it's $3,500 a month for care in an assisted living facility. How would it affect your assets under management if clients began asking for $5,000, $6,000, $7,000 a month? Here are some numbers showing inflation. As you can see, it's almost $200,000 a year in 20 years. The average stay for a male in a nursing facility is 2.2 years versus 3.7 years for a woman. The cost is substantial and can truly affect a client's portfolio and, in turn, your assets under management. About 70% of individuals over 65 will require at least some type of long-term care service during their lifetime. Over 40% will need care in a nursing home for some period of time. And again, here are the average stays for a male and a female. Let's do some basic math and check out a potential scenario. Let's say your firm has $100 million in assets under management. That $100 million has come from 500 clients. Of those 500 clients, 50% are over the age of 65. 70% of those over 65 will go unclaimed. The average annual cost of long-term care in 2015 is approximately $84,000. That's a potential annual loss to your assets under management of just shy of $15 million. I know this is a worst-case scenario, but even a 7% drop in AUM can be significant, let alone 15. How many clients would you need to break even each year? So now let's talk about how we can mitigate some of these losses or help to hedge against them. We have a few different options when it comes to LTC. Each have different benefit features or flexibility options depending on your client's needs. The following figures and case studies will be based off the same hypothetical client. A 60-year-old male and female for joint policies using $100,000 combined, and a single life policy on a male for $50,000. Let's look at traditional long-term care. Let's say your client purchases an LTC policy with an annual premium of $5,300. That'll give you coverage for 19 years to get us to right around that $100,000 mark. Keep in mind, that's only to age 79. We recommend at a minimum having coverage through age 90, which would then turn that number into about 150. This option has a 3% compounding inflation protection, which, as you can see, will boost the benefit pool. So in issue, you'll have $175,000. By the age of 85, that benefit pool will balloon to $355,000. Same goes for the month. At issue, it's $4,500, but by age 85, it's $9,100. Keep in mind, this is traditional long-term care, so it is a use it or lose it option. It may be the cheapest option in terms of premium, but keep in mind there is no death benefit feature, so if there is no claim, it could end up being one of the more expensive options. We also have shared care. If one of the insureds uses all of their LTC pool, they can cross over into their spouses. There's an adjustable inflation protection option. This is unique. It will allow you to increase coverage by increasing that inflation protection or reduce premiums by bringing that inflation protection down. There's 40% of the monthly LTC benefit is available in the first 90 days of the elimination period, which is great. That gives your client a little bit of a cushion during those first 90 days, which is helpful. Let's talk about life with long-term care. This option is available in most states, although not all carriers offer a true long-term care rider in New York and California. There's a couple different disbursement options. It can be either indemnity or cash or reimbursement, which is essentially showing a receipt. Depending on carrier, there's going to be a different elimination period. Some carriers allow you to choose 60, 90, 180 days. Others have a locked-in 100-day elimination period. With this option, the benefit will always be used, whether it's for a long-term care claim or a death benefit in the event of your client's passing. The two examples I have here are an inexpensive versus guaranteed option. The inexpensive option is guaranteed for 20 years, while the guaranteed option is guaranteed for 40 years or to age 100. You can see that the inexpensive option is going to give you a larger death benefit. In turn, will allow you to take a larger monthly benefit, whereas the guaranteed option has a smaller death benefit and a smaller monthly benefit. Now let's take a look at some hybrid products. Both of these hybrid products are lump sum products. They're going to be single premium options, and both of these products have coupled discounts or joint policies. Option 1, it has immediate inflation protection, meaning from issue there's going to be an inflation protection helping you hedge against inflation. So there's a 0-day elimination period. It is not a second to die policy. It leverages your premium dollars 4 to 1. You have up to 6 years of long-term care benefits, and it is fully liquid in year 6. Whereas option 2 has a 30-day elimination period. It has a second to die policy built in, and there's a double monthly benefit option if both go unclaimed. There's also 25 or 50-month benefit periods, and this product is fully liquid in year 10. So now let's look at the figures for each option. Option 1, you're going to have coverage for 6 years with inflation protection from the onset. That gives you a death benefit at issue of $196,000, and at age 85, it's $142,000, decreasing as the cost of insurance increases. Conversely, your long-term care pool is going to increase with that inflation protection. So the benefit pool will start at $460,000 and reach $1.1 million by age 85. The monthly benefit will start at just shy of $6,000 and be about $14,300 come age 85. Option 2, you have a death benefit of $209,000. The monthly benefit is $8,300 each, and the coverage period is 25 months each. There's additional riders. One is in a double coverage rider. This allows you to turn that 25 months into 50 months. So both insurers will have 50 months of coverage. You're able to add inflation protection on the riders, whereas in option 1, the inflation protection is from issue. On option 2, your base policy does not have inflation protection, whereas you can add it on with a rider. So there's double coverage rider to double your benefit period from 25 to 50 months, cost an additional $3,500 of premium a year, and then there's a lifetime coverage rider that would cost an additional $8,400 a year. With the lifetime monthly benefit, by age 85 and the compounding inflation protection, the benefit pool is going to be $17,000 each. Now let's talk about a couple unique solutions that not many people in the industry are aware of. There's a qualified money for long-term care option, as well as an annuity option with a long-term care benefit. The annuity option is great because it will help eliminate capital gains by repurposing that annuity for long-term care. Here with the qualified money option, option 3, you'll notice that the figures are the same as the previous slide because it is essentially the same product, the difference being that you're able to use qualified money. The way this works is you will 1035 exchange money from a qualified account like an IRA. That 1035 is going to purchase an annuity. The annuity is then going to fund a whole life contract with a long-term care rider. What's nice about this option is the tax event created from the 1035 exchange, instead of being due in year 1, is spread out over the life of the contract, which is 20 years. So for simplicity's sake, let's say you take $100,000 out of an IRA. Let's say you have a $20,000 tax implication. As opposed to paying $20,000 in year 1, you're able to spread that out over 20 years, taking a $1,000 hit each year. It's a unique option. It's great, especially for financial advisors who are managing IRAs and qualified accounts. The second option, or the fourth option, excuse me, is using an existing annuity. Let's say you have a client who has an annuity who doesn't necessarily need the income from that annuity or who is more concerned about long-term care. You can 1035 from the existing annuity into this specific product, and what it will do is it'll leverage that existing annuity for long-term care. So every dollar spent on long-term care is going to be coming out tax-free, in essence, eliminating the capital gains tax from that initial annuity. Protecting your clients is your business. Protecting your assets under management is good business. Protecting against long-term care is one of the best ways to create a legacy client. If you haven't allocated any money to long-term care, you have essentially allocated all money to long-term care. Does it make sense to use insurance to cover some or all of your clients' LTC needs? Lastly, I want to mention our complimentary back office support system. It is being featured in next month's Insurance Newsnet magazine, so I want to go over just a couple of the benefits here. With our back office support system, you have life case statuses. You're able to follow along from submission to approval, as well as track in-force business. We have in-force data feeds coming in, which allows you to see a snapshot of your client's policy at any given time, as opposed to going through the hassle of calling the carrier. You have the ability to see your commission schedule, as well as the commissions for all products offered. And what's unique is if you have a downline of agents, you're able to set their commission schedule, track their hierarchy, as well as their production. You can view your different appointments. You can access all documents, whether that's an application or a change of beneficiaries form. We also have a live chat feature with your dedicated case manager. There's a built-in quoting engine, as well as producer statements that give you a snapshot of your year-to-date production or the production you've done with BackNine. Those are just a few of the features for our Producers Place, our back office support system. That's it. I want to thank you for joining me this morning to discuss solutions for protecting your assets under management. I hope everybody learned a little something new today. I will be available by phone or email, and everyone will be receiving an email that contains a recording of the webinar, the slides, and a companion marketing piece. Thank you again, and I hope you have a great day.